Now a second economy story. NewsHour economics correspondent Paul Solman begins a two-part look at the investment bank Goldman Sachs. Tonight, how it makes money. The company reported a record $13.4 billion profit last year. It's part of Paul's reporting, making sense of financial news.
Do you solemnly swear or affirm, under the penalty of perjury,
kicking off last month's inaugural hearing of President Obama's Financial Crisis Inquiry Commission, CEOs of the four biggest banks. In the hottest of the hot seats, Lloyd Blankfein of Goldman Sachs.
In the end of the day, and I'm going to press you on this, it seems to me that you survived with extraordinary government assistance.
We never anticipated the government help. We weren't relying on those mechanisms.
And just a year later, venerable Goldman Sachs, beneficiary of bailout largesse, is the most profitable firm in Wall Street history. So how did they do it? Lloyd Blankfein told the Times of London, "We're very important. We help companies to grow by helping them to raise capital," and that he was just a banker doing God's work. Now, the interview seemed to play better as comedy than PR.
Despite collecting the highest salary on Wall Street at $68 million a year, Blankfein never forgets that he is, quote, a blue-collar guy. I believe he is referring to the sapphire choker he wears on casual Fridays.
Now, Blankfein took only a $9 million bonus for 2009, much less than in recent years, despite record profits. As for a defensive finance, he elaborated under oath.
Is what we do a lot for the economy isn't that visible as an investment bank. We help allocate capital, we raise, we put companies together, we launch new businesses.
So that's how Goldman Sachs is supposedly making money, as a traditional investment bank. Well, not according to Nomi Prince, a former Goldman Sachs trading strategist, now a senior fellow at Demos, a progressive think tank.
That classical investment banking function is a very small portion of their revenues. I think it's about 10% or so. So if he's doing God's work, he's only doing it at 10% capacity.
Most of the rest, says Prince, is so-called proprietary trading for the firm's own account rather than its clients.
They're a trading house. They can talk about being an investment bank and doing God's work and helping, raise financing for companies and all in that. But in the scheme of things, they do very little of that.
Another longtime Wall Street insider from the other side of the political spectrum agrees, though he doesn't disapprove.
I think first you have to admit they are very smart, they are very capable, and they have a huge franchise in the global capital markets.
David Stockman, President Reagan's budget director, went to Wall Street in the mid-'80s.
Take their results that just came out in 2009. They had $45 billion of revenue, of which $35 billion was from equity and fixed income trading and commodities and currencies. Now that's 75% of their revenue was basically from trading.
So when a Republican friend of mine, used to be in the Treasury Department, says that Goldman Sachs is a hedge fund masquerading as a bank, that's true?
Absolutely true.
And you could look it up, since Goldman's financial filings are public records. Only a tenth of its revenues came from investment banking last year, more than 3/4 from trading for its own account. But while the firm itself declined any interviews, if it's subordinating the God's work of investment banking to making money on proprietary trading, well, says Jeff Mackey, who's run a hedge fund of his own, so what?
Goldman Sachs analyzes their investments as carefully as anyone. Right now they're saying that proprietary trading is a better business for them.
But with all due respect, that is not God's work.
Listen, I'm not saying that they're necessarily doing my God's work, but as far as they're concerned, they're doing financial God's work. You can argue whether or not they should be doing this, but what they really should be doing is making money for the shareholders. That's their job. It's not theirs to judge who or why or how they're going about it. They need to make bucks for shareholders.
But consider how they're making those bucks, says Nomi Prince, on inside knowledge that comes in, as when she was there, with every trade a client asks Goldman to make.
And just by evidence from the profits that they make and where they make them, what divisions they make them in, they're not sitting on that knowledge. They are trading on that knowledge.
So they know somebody's going to buy a commodity or a currency, so they either buy that commodity or currency first or a commodity and currency very much like it.
Any information that you get, particularly if it's going to move the markets a lot, is going to filter in to the trading positions you take.
But isn't this front running, trading ahead of your clients to profit from the price changes that will come from the client's trades, but for your own firm's benefit? And isn't that, strictly speaking, illegal?
The long and ancient secret of Wall Street is they've always been front-running their clients. In other words, when you're in the customer trading business and then you're in the proprietary business, which trade are you making first? I don't know, and if it's in milliseconds, how's anybody going to figure it out? So I don't know if you ought to get all exercised on that or not, but the fact they make all this money in proprietary trading is clearly part and parcel of being a massive player, dealer in the markets for both customer trades and house trades.
So Goldman might insist that technically it isn't front-running, or that the charge could never be proved. So let's move to another. How about the extravagantly profitable bets for its own account that Goldman Sachs, as some call it, placed with insurer AIG, against the very products, mortgage-backed securities, that the firm was trading to customers? McClatchy reporter Greg Gordon was the first to uncover the practice.
In 2006, Goldman began in different ways to make bets that the housing market would turn south. When you're selling $40 billion in securities, U.S. registered securities to investors here and abroad in 2006 and 2007, and at the same time you're secretly betting that these securities are going to go south, they're going to lose value, well, that raises a big question.
Lloyd Blankfein's response?
What we do is risk management. Because we had this risk, because we were accumulating positions, which, by the way, we acquire from clients who want to sell them to us, we have to go out ourselves and provide and source the other side of the transactions so that we can manage our risk. These are all exercises in risk management.
Well, I'm just going to be blunt with you. It sounds to me a little bit like selling a car with faulty brakes and then buying an insurance policy on the buyer of those cars. Pension funds who have the life savings of police officers,
These
teachers.
are the professional investors who want this exposure.
Professional, sophisticated investors who should have known what they were getting into with mortgage-backed securities, a theme Blankfein hit again and again.
A sophisticated investor that creates the exposure that these professional investors are seeking. Again, the most sophisticated investors who sought that exposure.
And look, says investment advisor Jeff Mackey, even if Goldman's people are more sophisticated than their clients, Blankfein's still right.
Caveat emptor. Goldman Sachs didn't get to become Goldman Sachs because they're bad traders. Of course they know more than the other guys. They're packaging the goods. It's their book. They know more about it than anyone. And if they're selling it, well, you probably don't want to be a buyer. I want to buy things from people who I know more than, not people who are creating these instruments for me to buy.
But pension funds don't bring in the math whizzes, the quants, the people that Goldman Sachs has. They're no match for Goldman Sachs' salespeople or traders.
Generally speaking, they aren't. So what is your pension fund doing involved in these securities?
Even if you think Mackey and Blankfein provide a reasoned defense, however, one huge last question remains. Has the firm been making record profits with your and my money? We'll look at that next time.